everybody. Well, welcome along to this pre-market address. This is as we move into Wednesday's session, the 11th of March 2020. First of all, I hope you are doing A-OK no matter where you are located around the world. This is a little bit of a special address. It is relatively important as we continue to beat our heads on into the area of roughly 2,800 to potentially as low as 2,700 on the S&P 500. I understand at this particular time emotions are running relatively high. There is still a very high degree of volatility in the marketplace. It has been a tremendously volatile start to this week's worth of trade. Really on Monday, we saw that significant move to the downside whereby the markets collectively across the board, they closed down, just over 7%. And then, of course, during Tuesday's session, we saw the markets again rally in the bullish direction, contrary to that of what we saw on Monday, closing up roughly around 5%. The Nasdaq, I believe, was the best performer. The S&P lagged only marginally, and the Dow Jones Industrial Average closed relatively strong as well on Tuesday's session. So here we are, heightened volatility, still continuing, or at least still persisting in the marketplace. A lot of people obviously uncertain about the market. Obviously, the coronavirus, at least a lot of this market activity at the moment, appears to be headline driven day to day. And overall, if you're feeling, if your stomach is a little bit sick from rocking backwards and forth, hopefully this market address as we move into Wednesday's session at least is going to give you a little bit of structure, a few signposts as to what the market is doing at this particular time, and also what to look for, not only for the remainder 3 sessions of this week, but this may continue, especially around this battleground area for a number of weeks into the future as well. So I'm going to do my best to absolutely recap this for you and to, again, give you a few signposts as to help you moving forward. Now, I've already sort of almost anyway recapped Monday and Tuesday session. Really what we can take away from this is, again, volatility remains high. Uncertainty, of course, remains elevated. And as such, fear and to a degree, an amount of panic is really just engulfing this market. A little bit of a relief rally as at Tuesday. However, as I sit down and bring you this special recording as we move into Wednesday's session, I can see that the futures themselves at the moment are down close to 3%. So we'll see where that takes us during Wednesday's session. However, I just wanted to point out the fact that we are still looking for that, relatively speaking anyway, that of a basing pattern to show up. Now, again, there's a good chance that given the trading activity that we've seen on Monday and Tuesday, and of course the overshooting of what has been that temporary sort of short-term stop to the waterfall sell-off, which took place in the final trading session of February, there's a very good chance that this is going to be a flush out to the downside at the moment. It has come a little bit sooner than what initially I thought this type of move would actually sort of set up and progress. However, again, you can see on Monday that we've actually moved below that of Friday's structural intra-session low. However, on Tuesday, we saw a very quick reversal off from and even a retesting of roughly that 2,750 area on the S&P 500. Now, this is very critical for you to understand. It's not necessarily what is driving the markets headline speaking, but really what we want to understand is, well, is this potentially a very good location, or at least a logical area for the markets at least, to establish that of a formidable battleground, or at least the continuation of the battle between buyers and sellers very close to this primary bullish trend line. I've referenced this over the past number of videos. It has been a very important target for this market in terms of the intermediate move. And if I just show you this on the oscillating indicators at the moment, if I push the W key to bring up the weekly oscillator settings, you can see that now we're getting a secondary retest into this oversold level on the RSI. The stochastics, it still has a long way to go. And the MACD, technically speaking, as at the close on Tuesday, and this third histogram bar is still accelerating, obviously into negative momentum, which suggests that we haven't actually seen the end of this intermediate move. And there's a good chance that this intermediate move, this intermediate correction, now that the markets are probably at least going to open up back into bear market territory, so to speak, on Wednesday, there's a good chance that we are still going to see some lingering selling pressure overall. However, I want you to understand that when I bring up this green rectangular tool on my screen, this general vicinity is a very sort of, molecular laser focused sort of target, very similar to what I was speaking about, all right, publicly again, back in the period of late 2018. If there was going to be any formidable area of support, and this very much so applies to this week as well, given, of course, the futures and what it looks like on Wednesday. if there is a logical laser focused area of support, this is where it's going to show up on the S&P 500. We've been speaking about this again since the beginning of the sell-off. We've overshot past support areas, but we've always had this primary bullish trend line in the event that the market continued to push beyond some of those previously talked about, right, support areas on the chart itself. And again, just to write this down on my chart, we're looking at an S&P 500. It may not get all the way down there, but the battleground figure, essentially that line in the sand, is coming in as per this projection of the primary bullish trend at roughly 2,700 points. Now, I understand at the moment the S&P as that Tuesday, it closed at 2,882 points. So logically speaking, right, that's another 182 points, give or take, until technically we'd come on back down for the first time since the fourth quarter of 2018 to again test what has been the macro continuation, really the underpinning trend line of the S&P 500 since the beginning of this bull market, all the way back in 2009. And the reason I'm taking the time right now to give you, or at least to bring you this special address for those who are willing to watch, is because leading up until the peak, we were talking about how this was the antithesis of really what was establishing itself back in the lows of 2018, at least in the fourth quarter, right? As we moved through Christmas, and then we began what was the blockbuster year, right pretty much through to the close of 2019. If I can zoom on out and show you this, just so you can visually see this for record, this was really the beginning of 2019. You can see on my screen over here, January. This was the depths of the sell-off, whereby again, we came back on into the bullish primary trend line on the S&P 500. And really all of the video discussions that I've put out up until this intermediate top in the midpoint of February has been calling this period in red over here, which is sort of inversely colored. This should be obviously green for the bullish momentum of the market, and Q4 of 2018 should be sort of red colored if you wanted to color coordinate it. But again, we were talking about how a lot of, I guess, the sentiment and the emotion of the market was, I guess, the bipolar, or at least the opposite to what was happening back in the depths of 2018 in the fourth quarter. And we were speaking about a lot of warnings. Now, I want you to understand, and just reference this for your own sake, just how quick sentiment can shift in the marketplace, whereby up and around these highs at say 3,400 on the S&P 500, people were completely carefree, right? It was as if nothing was going to bring the market down. If you fast forward, obviously, where we were at the midpoint of February, back to even where we were as of Monday of this week, whereby we saw the market's opening limit down first thing on Monday morning, and then of course continuing to push lower, right? It really is the antithesis of the bullishness that was really occurring less than 1 month ago. So for your records, I want you to understand just how quickly, again, mass psychology, trader psychology, active and also passive, right? I guess sentiments of market participants can shift. And right now, the pendulum itself, it is swung from a complete state of greed up here at the peak of February, or what has been the peak of 2020, to a complete sort of inverse relationship whereby the market itself, you could argue, and I don't think it's really all that contentious, whereby it's really gripped again by the headlines as to what is coming up in terms of the updates of this coronavirus. Now, again, the market's rallied for essentially 2 months, not knowing the full extent, obviously, as the underlying problems globally, but really, at this particular time, I don't think you can really find all that many bulls with much conviction, all right? Or so it may seem. They may be lurking out there and not really saying a whole lot. There are a lot of talking heads, obviously, on the financial media channels talking about, all types of things, the odds and the probabilities of recession, and how we're bordering, obviously, right now on a 20% sell-off, so to speak, at least at the lows of Monday and also the intra-session lows as at yesterday being Tuesday. And I wanted to just remind you very quickly as to the sentiment and obviously the fear that was gripping the market all the way back in, of course, of December of 2018. It's really only been a year and 2 months, you could say, from this point over here. But what we're witnessing right now in terms of just people's just general reactions to the market behavior, and of course, linking that to the coronavirus headlines that are being printed almost to the minute around the world, the updates that are coming out, both good and also bad. It's very similar, or at least I wanted to make the point that it is very similar to where we were during that of the period late in December whereby, right, surprisingly or unsurprisingly to those who have this information and knowledge, whereby we came on down for the most recent time anyway, where we came and had the very temporary battle at, of course, that primary bullish trend line, which started, if I can zoom on out and show you this, just the degree of how powerful this is, all the way back in 2009. Now, I understand my chart when I zoom on out and give you, at least try and show you this much information, it becomes or at least there's a lot of sort of horizontal lines on my screen. Don't pay attention to that. Just pay attention to these fan lines, or at least these trend lines, which have been in effect since the lows of 2009. And on every occasion, so to speak, and maybe I can better show you this through the actual timestamp of the monthly chart, but every time the market has come on back down, and this is a monthly chart, so there are a lot more touches on both the weekly and obviously the daily time frame, but every time we have come on back down into this area, most noticeably again back in the fourth quarter of 2018, as bearish as what the prevailing sentiment was, the market has held this level. Now at this particular time, and as we move into Wednesday's session, I'm not suggesting in full confidence that this level is going to hold, right? All I'm suggesting is that historically speaking, and if we are to see the continuation of this bull market, I wanted to make the point again that this is a very logical area, a very laser focused area, mixed with, of course, the oscillators on the daily time frame, okay, that are extremely oversold. If I can bring this up on the oscillators, here we go. This is now the daily time frame of the oscillators. Got the RSI pushing out on 2 occasions now at a short-term oversold settings. To me, it looks as though the histograms are trying to sort of at least stagnate a little bit and are potentially as a whole beginning to slope back towards the net neutral line on the MACD. The stochastics is beginning to cross, right? Although in and of itself, these are not just simple buy-sell triggers. We use them in combination with other pieces of technical analysis. But when you bring this all together, and of course, when you think about the trading sessions that we've seen on Friday as of really 2 weeks ago now, this is Friday as of last week, and then thinking about how the market itself, collectively, it's not only applicable to the S&P 500, it's also applicable to the Dow Jones and the NASDAQ, whereby psychologically speaking, right, we saw the complete capitulation on Monday, but what we didn't see was any follow-through, so to speak, on Tuesday's session. Now, again, a lot of this is probably going to be in coordination with both monetary and also fiscal policy, not only domestically in the United States. Also, I mean, I can speak for myself in Australia. Our government is taking action right now, at least, or they're in the works of anyway coming out with some form of a fiscal package. Not to mention that our central bank cut basis points in an unofficial meeting last week, and of course, the Fed came out and cut U.S. interest rates and a further 50 basis points last week. But there's a good chance, and it's interesting that you parallel this also, because exactly the same thing happened in the fourth quarter of December of 2018. If you go back and have a look, the Fed took urgent steps to help support the market. Whether or not fundamentally that is a good thing, all right, I don't think it is personally. However, it's coordinated at roughly, and I find this very interesting, to be that same area on the chart. Again, if you provide or make an extension off from those past series of higher highs, or in this particular instance anyway, the continuation of the trend being the higher lows. So again, now that we haven't seen the follow through on Tuesday, this is going to be a very big test for the market as at Wednesday. But I just wanted to make the point again that as people moved into some form of an irrational panic back in December of 2018, I hope you can pick up on that there, to some extent, right, there are some very important parallels which are potentially, right, coming together on the US financial markets as well. Just as they did on every other occasion, the market has moved from a peak to trough of roughly 20%. Now again, we're probably going to open up very close to it. We've got some markets, the transportational average and also the Russell 2000, which are beyond that at the moment. The closely followed US markets are still really yet to push definitively into, technically speaking, that bear market territory of 20% or more. But as those oscillators continue on the daily time frame to push into oversold territory, mixed with, of course, the psychological flush out over here and potentially a lot of new fresh short sellers being, right, potentially buying to close, so to speak, or being caught at the wrong area, again, largely being driven emotionally speaking, it makes a lot of sense that we could begin to see a battle develop between buyers and sellers, upon which, right, there's a very good chance that we are going to see the buyers win out, just as we have done on every other single occasion that this market has moved into its primary bullish trend line since the beginning of this bull market expansion back in February or March of 2009. So keep an eye on it when it comes to not necessarily whatsoever the exponential moving averages, but pay attention to these oscillating indicators. Pay attention to these on the daily time frame. Think about the psychology of what's just happened on Monday, potentially being that complete sort of capitulation. The following candlestick as it yesterday being Tuesday, another lower wick right at the base, or at least the closing low of Monday's session. Think about also the prevailing bullish trend when you go out to the weekly time frame. Yes, we still have potential for further downside. However, again, it may be limited back into these lower areas on the S&P of 2,700 points. But for me right now, in looking at this and just giving you my thoughts, just like I spoke about back in the year of 2018, makes a lot of sense to keep very closely focused on this green rectangular box on my screen. Not saying it's going to definitively bounce off this area, but if there was going to be a definitive area for support to show up and for even the buyers to win out, it's going to be from the lows of Monday and Tuesday through to this bullish trend line down here. It's obviously not going to play out overnight, but if you see momentum exhaust itself to the downside, if you see the sellers unable to push the market below this strategic trend line on my screen, and then if you see, of course, candlesticks begin to set up, if you see those oscillators definitively flicking bullish, not only on the daily time frame, which they are more or less about to, but more importantly on the weekly time frame, as we have referenced that this is that definitive intermediate correction that we've just been waiting for really since December of 2019, it makes a lot of sense that once these oscillators flick back on up, we may be setting up that intermediate bottom, all right, which is now going to be the most recent, next at least, all right, high or low on the macro time frame, which again is the textbook definition of a bullish trend. Understanding, of course, back in 2018 in September, everyone again was relatively complacent. We were talking about at this time, and you can go back on the YouTube channel, in fact, and look at the analysis back in August, September. We're actually closing out of our long trades at that particular time at 2,852 points. So again, very similar to what has just happened, whereby we closed our trades out in December of 2019. We got out a little bit early, but as the market began to turn, and as the market continued to push further towards this bullish trend line, right, we can say that we were the very first, or some of the very first people to get on board with what eventually or inevitably played out once, of course, this trend line held. Now, it looked as though there was a moment in time we were breaking below it. The market reversed very severely and significantly out of that general vicinity. But I just wanted to make the point that it looked as though we had broken below it, only for really 2 sessions. And then, of course, we get this big outside engulfing candlestick, Fed to the rescue, market takes off, the rest is history. There's a parallel, at least, I want you to pick up on, that something very similar is beginning to shape up. It's beginning to play out. We are still very early in, right, the turning of this move, if it is to show up off from this bullish trend line. The reason I can suggest that, again, is if you go out to the weekly time frame, if you overlay all of these different oscillators, you can see, or at least it gives you the degree upon which we're into, or is far into, that being that of the intermediate correction. And your best friend, again, is going to continue to be the moving average convergence divergence, the MACD. It's going to be your best friend in this type of scenario. Now, again, if I show you this on the Dow Jones Industrial Average, we still have a little bit further to fall, all the way down to potentially as low as 22,000 on this particular market. Seems a bit crazy because we're all the way up here at 25,000. I understand that's 3,000 points away if my maths checks out. But what we're seeing right now on the weekly time frame is the beginning of a hammer candlestick at support. And in the past also, we've spoken about the market itself overshooting and freaking a lot of people out who were incorrectly calling this the first substantial lower low, which is just completely incorrect at this time. The low that you want to reference, again, keeping all things similar on the fractal, will be, of course, the most recent intermediate correction, which is really pricing off at a low point, if I move this over to the right-hand corner of my screen, somewhere around, surprise, surprise, 22,000. So I hope you can see how this analysis is coming together. I think we're if we had to measure between the beginning of the intermediate move as to where this market may settle, and I'm using the S&P 500 as the sort of the centerpiece of this, I think we're very close to, all right, somewhere near what will settle to be the intermediate low. But that doesn't necessarily mean you just go out and buy the market whatsoever. We've got no signals of a reversal and also a confirmation in price action of negative momentum at the moment, or breaking that of negative momentum at the moment. So again, you've got that hammer candlestick at support. The S&P 500, again, hammer candlestick at support. Obviously, we're only 2 sessions into this week, but this long lower wick over here, close to this bullish trend line, based on the momentum, is starting to give you some clues. The NASDAQ, again, only 2 sessions into the week. We're still down 244 points. We're looking to at least open on Wednesday relatively weak as well. But that same definitive target on the NASDAQ, based off the most recent intermediate correction, being that again of the fourth quarter of 2018, is still projected, right, to intersect price at roughly 7,500 points at the most, right, or at the deepest of potentially this intermediate correction. Doesn't mean we necessarily have to get all the way down there, but what this distinguishes is that of the continuation of the expansion being above this trend line, and then of course a legitimate correction below. And if we get below these trend lines that I've referenced, then we'll begin to shift our analysis. But as we've warned about, right, leading into the end of 2019 and leading up until the point in February, this is still largely expected, headline driven or not, coronavirus inflicted or not. This is still going through the same routine. This is still going through the same ebb and flow effect of what we have seen play off on every other occasion during that of an intermediate correction. And I'm hopeful at this particular time, just witnessing and walking through some of the broadly, or at least the closely followed markets, that's giving you hopefully some peace of mind. Now, the majority of people in pro have done absolutely nothing. If anything, they've got out and they've moved to cash prior to this sell side volume, or at least this sell side waterfall sell-off. And that's fantastic. I'm still receiving emails from people who have said they've completely sidestepped this chaos and they're just waiting to jump back on in. And I just wanted to warn you and to alert you that the time is still not here. The time is still not now. The reason is because we haven't actually seen confirmation of the movement, or at least of potentially the ending of this intermediate move. We've got warning signals suggesting that we may be close, again, based on psychology, based on candlestick patterns, based on the momentum of the oscillators, especially the MACD, and of course the continuation of those higher lows, but we still don't have the structure. And the reason for this video is just to proclaim that we are going to continue to see volatility persist in the market, but that volatility, as irrational as what it may seem, and it completely is to some degree, what may truly be happening again is the battleground, of course, between buyers and sellers who are transacting obviously at a very important level. Most people are unfamiliar and they've got no idea as to what this level actually is and the significance of this level. But I believe personally that the smart money, the institutional money, as fear is most elevated, as people are whipped up into the biggest state of frenzy, as people are most uncertain, as people are most fearful, obviously, of the immediate future, this is exactly what happens, whereby, again, institutional investors, the big money starts flowing back into the market to support it, and then it just feeds on itself once, of course, the public participation start to jump on board, like it happened and as it played out really throughout the majority of 2019. Now, I'm going to keep you updated on this, but again, I hope there are some people out there who appreciate this as we move into Wednesday, and hopefully you've got a better understanding of what's going on and what to look for, and of course the importance of this trend line down here just below, okay, the lows of both Monday and also Tuesday on the S&P 500. My rough estimate is that potentially to actually intersect with this and to actually tag this extension of the trend line, it's about 180 points from where we closed at on Tuesday, being 2,882. And in a rough sense, of course, the target being somewhere around 2,700. The difference, obviously, of 2,882 And 2,700 is giving us that rough 180 point drop, whereby we may not stay here for long. We may stay here for a few weeks, but at least it's a general location for you to look very closely at how the market moves, how it reacts, how it trades around this general location, which I think could unlock the key for a lot of return, right? And setting the stage for what may seem to be a completely absurd, right, movement further into 2020 in the opposite direction as to how the markets have really begun, at least sort of said farewell to February, and also have begun at least March of 2020. I'll keep you updated along the way. But again, I hope that helps people out there who are looking for legitimate, credible information of the application of technical analysis to the US financial market indices. If you've come this far, have a look into that pro analysis class as well. We go into more detail each and every Saturday. It's up on the website. All right. All the best, everyone. It's James signing off on behalf of Pivot Point Trading. Farewell.